Hey, what's going on, party people? It is Rags to Riches here with another episode for the Crypto Chronicles. I am here today to talk to you guys about my portfolio, recent returns, the cryptocurrency market, interesting news that has been happening as of late. Of course, to give you a portfolio update and to talk to you about things like the FOMC meeting that we had yesterday and Bitcoin having a golden cross. So things are about to get spicy in the markets as we head into the end of the week and into the weekend. On that note, let me pull up my Brave browser here. For anyone who's unaware of the Brave browser, this is a Chromium based browser that was developed by the same people who made, I believe, Firefox. And it's a really cool project where you can actually get paid out BAT, basic attention tokens, for browsing the internet. The way that works is that rather than having traditional ads going to websites, which the website hosts get paid for those advertisers to put those on their sites, and your viewership is the reason why they pay them. They actually have the ad blocker built into the browser, and then as a reward for seeing periodic notifications, not ads clogging up the internet as you try to browse through Yahoo Finance and CNBC, and if you're like a girl, BuzzFeed, I guess. Pardon me, because I'm a smoker, kind of. You can actually see many notifications and they get paid out basic attention token for engaging with those ads. But on that note, getting into the portfolio update, as you can see, we are sitting at today's staking balance of $6,277.42. Portfolio balance as of right now is sitting at a clean $7,600. We are making some waves as far as the week goes. On weekly returns, we're up about 5.86%. On the daily returns, up 5.68%, weekly 6.08%, and on the monthly returns we're up about 17%, which is phenomenal compared to traditional equity market returns on an annualized basis of about 7 to 10% for the S&P 500 or NASDAQ or whatever index that you like to engage in on your end here. But as you guys can tell, this is my altcoin portfolio. We have 10 primary holdings that we actually invest in, those being Polkadot, a layer 0 interoperability solution for cryptocurrency; Polygon, this is a layer 2 scaling solution for Ethereum; Fetch AI, this is AI technology built on top of blockchain for the benefits of decentralization and security. You got the Render token, which is decentralized GPU computing; the Graph, an index solution, think Google but for blockchain technologies. You got Chainlink, this is a Oracle solution that allows blockchains to interact with real world data in real time. A lot of applications for this, which we're not going to get into today. Filecoin, think decentralized storage, the Google Drive of crypto; VeChain, supply chain management for businesses like Louis Vuitton; Kava, which is DeFi, that is operating off of the Cosmos and Ethereum blockchain. And speaking of Ethereum, you got that right there as well. Now, the reason why I invest in all these tokens is because I am a cryptocurrency miner. I use iApollo SE Mini Pluses to mine both Ethereum Classic, as you can see here, and Zilliqa, as you can see here. Now, when I receive these tokens, I then sell them to get USDT. This is a US dollar stable coin, which I then immediately use to purchase these altcoins. Now, outside of the general themes of those projects, which I was alluding to, the reason why I invest in many of these tokens is because they operate off of a proof of stake protocol. In the simplest of terms, it allows me to get passive income from my cryptocurrency portfolio. This is what is known as staking. And speaking of staking, the staking rewards for these respective projects has actually changed as of yesterday. Ethereum's yield went up to 7.3% from 4.1% the last time I showed you. So nice. I like more compounding returns. VeChain still sitting at 1.1%. Polygon is sitting at 3.1%, so no change. Fetch AI is sitting at 4.2%, so went up 10 bips. Excellent. Polkadot sitting at 13.3%, so no change. And then Kava, the sleeper cell, is at that 16.2% yield. This is like some high yield defunct stock or something like that. That yield is crazy. But But yeah, on that note, basically what I do is I mine cryptocurrency. I invest in the projects that I see have a long-term potential for return, and then I allow them to give me some passive income. And that is exactly what has taken place. So over the past evening, every Wednesday I get paid out my blockchain cryptocurrency rewards. I sound like a nerd when I say that, but probably because I am. Yeah, we got a 0.00126669 Ethereum. We got 0.55 Fetch AI, 0.77 Kava. Yeah, keep scrolling here. Oh, there it is. VTOR, 27.28 VTOR. And then I probably got some other awards too, but it's just like, just gonna let it compound over time. So, portfolio has been doing well. Let me actually take you guys over to CoinMarketCap here. Just need to pop open a new browser. Let's do one thing. So, CoinMarketCap, there we are. Yep. And we logged in? Yes, we are. Cool. So, portfolio on the last day has been, I wouldn't say rallying extremely hard as it was the week prior and the week prior to that, albeit we have seen some consolidation and some grinding upwards in the projects that we are invested in. The tokens that have been doing very well as of the week before are the same tokens that are still grinding up today. Fetch AI has had a 7-day return of about 18%. The graph is up 11.36, Render up 10, Kava 6, Polkadot 5, Zilliqa, one of the coins that I'm mining, so that means increased passive income from these mining activities, up 4.6, Ethereum Classic 3, Bitcoin 1.3%, but there is some interesting news about this, which we are going to be getting into in just a moment, so stay with me if you're about to click off the video. Matic up 1.25%, Filecoin up 1.25%, Chainlink down, VeChain down, and Ethereum down. But that's all okay, because we saw some pretty crazy rips up in price as of the week before. Now, getting into the news, why we are here today. Yesterday, the Federal Reserve, my man Jerome Powell, actually had his meeting where he decided to pause for another rate hike for the month, which is great for the market because he has been really messing up the wealth building plan, but that is okay because he needed to normalize interest rates and inflation was far too high for anyone's liking. I would rather have a 8% mortgage than to pay $100 for a loaf of bread as though we were in Weimar, Germany. Now that is a joke that may have gone over many of your guys' head, but short historical context, prior to World War II Germany with all the disgusting acts against humanity and before all that took place, Germany, it was called Weimar Germany at that point, was coming out of World War I, had to pay reparations for the damages they caused to other European countries at that time. They were unable to pay their bills, they inflated their currency to abhorrent levels, causing hyperinflation in the country, and people literally were burning money to heat their house because money had that little of value. Money, it's basically like the reason why inflation is bad is because if left unchecked, if left out of control, if the government continues to, people say print, and we could get into the technicalities of what that means, but just print money indefinitely can lead to the value of a dollar, whatever currency that you use in your home country if you're watching this internationally, to be less than even that of wood. Definitely not something that you want, and that is why the Fed has been raising rates to make sure that we do not get into that position. But yesterday, after a period of a year of pain, raising rates up to 5.25 to 5.5% for the FOMC funds rate, Jerome Powell decided to pause rates. I'm going to get into the article here. So here's what changed in the new Fed statement. This is a comparison of Wednesday's FOMC statement with one issued after the Fed's previously policy making in September. Text removed from September's statement is in red with a horizontal line through the middle. This isn't too much, so let me just give it a read here. So, recent indicators suggest that economic activity expanded at a strong pace in the third quarter. Job gains have moderated since earlier in the year but remain strong, and the employment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risks. The committee seeks to achieve a long-term maximum employment inflation rate of about 2% over the long term. In support of these goals, the committee decided to maintain the target range for the federal funds rate at 5.25 to 5.5%. Blah, 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 going to continue to look at information and be data dependent, and I'm Jerome Powell and I control the economy and the money printer, blah, 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 blah. Let me cut through the chaff. This meeting was dovish. Dovish means that he's considering the idea of a true pause, not cuts. The notion of higher for longer is likely here to stay. In even more simple English, Jerome Powell said, I think I've gone a bit too far. We need to make sure we haven't done too much damage. Can't have any more banking crises like the Silicon Valley Bank, more crypto fallouts like FTX, people losing all their money. The American people are going to freak the out. So, what he did this time is say, let's pump the brakes, see what's going on, not raise any further, and we'll assess next month if we need to keep going higher. Now this is good for markets because it provides a level of certainty that at least for the next 30 days, we're not going to see any major changes to interest rate policy, which then has an implication to the bond market, which then trickles into the stock market, which then trickles into the crypto markets, because everything is a risk on asset compared to what the Fed is doing. Now, why does this matter for crypto? If the idea of cryptocurrency is to decouple oneself from the traditional markets. Well, after the meeting took place, click, Bitcoin retook $35,000 after the FOMC, and Solana's leading the crypto altcoin rally. We can definitely get into the chart for Solana in a little bit if I feel like it. But just getting into the news here, it looks like Solana ripped up about 16% as of the end of the FOMC, which is great. And then Bitcoin is at a very serious level of resistance, that being at about $35,500 to actually break out upwards. It has not yet broken out upwards, but the more positive catalysts that we can see for Bitcoin as it approaches and as it is at this resistance level is going to be really positive for the market. Bitcoin leads crypto. It is the first mover for the technology, for sentiment, and for price action. Should Bitcoin break out from its current level upwards to 36,000, 37,000, 40,000, etc., there's a pretty clear shot to 50K, 55K, 60K, perhaps even the all-time high as we approach the halving event. This is going to be an extremely bullish catalyst for the altcoin markets as people look to take on additional risk outside of the volatility proposed by Bitcoin to find even more outsized returns. So that is very positive. We're actually going to get into the Bitcoin chart because we're seeing some really good technical indicators as far as the asset class is concerned, providing supporting evidence for that thesis that I just laid out to you there. Now, coming in from Forbes, imminent $3 trillion watershed moment. 300% crypto price shock could be about to blow up Bitcoin, Ethereum, and XRP. Now, these guys are talking about Bitcoin getting to 35,000, XRP being the bank's favorite crypto, albeit I don't know why they don't just use Tether or USDC rather than a volatile asset that's a risk on security rather than a stable coin, but that's not for me to decide. Blah, blah, blah. Like, basically, they're just talking about all the stuff that we've been talking about as well, like, right? Let me just, like, high level. Okay. Bitcoin, technically in a good spot, hitting resistance. Analysts think can go to $150,000 per Bitcoin in 2025, giving Bitcoin a $3 trillion market cap. That's where the title of the article is coming from. People may not like Bitcoin as much as the writer of the article does, but if you view it as a commodity and one which is going to have increased demand with these spot ETFs, then the potential for higher price appreciation is definitely on the table here. And I agree with that sentiment. I think as we get more regulatory clarity from the advent of the spot ETF, and as the economy begins to normalize into this higher rate environment, what markets require for price appreciation, for new liquidity, and for new investors to get involved is People will say certainty, but I would say stability, right? Rates are going to be what they are, the market is going to be what it is, the economy is what it is, but when there's changing factors and unknown variables, it's hard for investors to make long-term assumptions about where prices are going to be, because if I don't know what tomorrow's going to look like, perhaps an investment that I make today may not actually pan out to what my plan thinks it's going to be. So on that note, I think we are heading into a very good season for crypto. Just need a few more positive catalysts and for Bitcoin to get out of this dang trend line above $35,000. Now, the reason why we are really here today is to get into this. Now, this is a premium article, and I will never pay CNBC $1 for their pro articles because they're oftentimes half-baked. But Bitcoin just formed a bullish golden cross signal, what it means after the cryptocurrency's recent rally. For anyone who hasn't day traded or done any technical analysis, well, good news for you, I am a day trader, or was back in the day, so I can tell you all about this handy-dandy technical analysis here. Let me take a drink of my pre-workout here because I am getting ready to go to the gym after we wrap up this video. Oh man. Alright. So this is a trading platform called Webull. It is where I do my charting for my equity portfolios. Fun side note about that, I have two main portfolios. One is a growth stock portfolio based on thematic trends. Another is a dividend cash flow portfolio sitting in my Roth IRA to protect them from double taxation. And I also do all my charting here just to make sure that my investments make sense from not only a fundamental perspective, but from a technical perspective. Taking a step back, when we think about fundamental versus technical analysis, what do we mean? Fundamental analysis is looking at news, cash flows, ability to repay, market cap, all the numbers associated with underlying securities to see if on a bottoms-up basis, does the investment make sense? Is it going to be profitable? Is the business doing exactly what it thinks it's going to do? Technical analysis, on the other hand, is looking solely at the chart to get an idea about what other investors may do in the future as far as where prices may go. I would say the fundamental analysis is looking at the underlying value of whatever security is in question, whereas technical analysis is investors using their insights and perspective to try to outsmart, to out-psychology, to do whatever they want to do against other investors into the market. Now, when you're looking at a golden cross, there are a few things to keep in mind here. Number one, there is a indicator for technical analysis called a moving average. This looks at the average price of a security over a set period of time. And in the case of a golden cross, you're generally speaking looking at two moving averages. Those being the average price over the past 50 days, the 50-day moving average, and the average price over the past 200 days, the 200-day moving average. Now, a golden cross is when the 50-day moving average is above the 200-day moving average. A death cross is the opposite, where the 50-day moving average is below the 200-day moving average. And if we go to the daily chart to actually quantify what was talked about in this CNBC article, as you can see here, our 50-day moving average has crossed over our 200-day moving average with this recent rally in Bitcoin's price. Now, why is this important? This is important because historically, when there are golden crosses, there is price appreciation. Let's actually go to the chart and see the last time this took place. Well, it took place here, but I want a better example. Alright. Bitcoin's price, trading range bound between, call it, $13,000 and $6,000 prior to the 2021 bull market. We head into the COVID-19 pandemic. The economy crashes down to the gutter because basically our government overlords decided to shut down the world, and then Bitcoin's price crashes to, call it, about $4,000. Everyone's freaking out, everyone's selling their Bitcoin, but some people saw opportunity and decided to buy into the project. Price begins to recover back to the mean from where it was before, and we have a golden cross above the 200-day moving average. And from there, the price stuck very closely to the 50-day moving average, leading to this massive bull market. As you can see here, I did a little bit of like I did a little bit of trend line trading here at some point, trading some crypto, but I should have stuck in it for the long term. I was so stupid. Yeah, so had a golden cross, price is ripping upwards, holding close to the 50-day moving average, was able to sustain that until it broke down beneath it, and this is where we saw the retracement down to the $30,000 price level. Going sideways. Again, another golden cross here, leading to our rally up to the all-time high. Come on. Yeah, whatever. And then going back down to where we are today, death cross, and this is where we saw the sell-off to $15,000, or the local low for our current price trajectory. Now, I do think this is going to be a sustained rally, going out in the chart to the weekly basis. This was a very aggressive pullback, about 75% from the all-time highs. That has been retried and retested multiple times. So we have firm support here at the $25,000 price level. This recent breakout is due to all the positive bullish catalysts here. And from a technical basis, we're looking to break out above, call it $36,500. This resistance, and then support, and then now it is resistance again, to actually see price targets of 44, 53, and then the next one I would say would be about $60,000, but if we're going that high, we're probably going to 70,000. Is this on the table? Is this definitely possible? Well, looking at the chart, this looks like a very bullish chart to me. We probably are due for a pullback and a retest, call it to about the $32,000 price level. But I do think it is in the cards for us to go above and beyond and back to all-time highs. So on that note, guys, I am going to get ready for the gym. Be sure to be informed as far as you are in your investments. Be sure to be kind to each other today as we head into another day of this chaos in the American working world. They call it the American dream, but perhaps you can consider it the American nightmare. But we are trying to escape the rat race. That is the moniker of this channel. So please turn your rags into riches and have a wonderful day. I will see you all next time.